So as we discussed in our first part that whenever the government spend money or whenever they change their fiscal policy, so it has a multiplier effect. And how it's going to be multiplier? The multiplier idea was introduced by Keynes. This is the economist who introduced. The multiplier is magnifies new spending into a greater level of income and output because each round of spending becomes an income for someone else. So as I mentioned, when government, for example, if government cut the taxes, so what is going to happen? Our incomes increase, so we spend more. So that's going to generate the income for others, and they're going to spend it. Then they're going to spend it. So it's a process started, and it's going to multiply. Yes, it's going to be multiply based on our MPC, how much we are saving or how much we are consuming. But if the government is also spending directly, so then the first step there is no MPC applied. The government plan that they want to spend $80 billion, so they're going to spend it 80 billion. It's not like that. Okay, if the MPC is 0.75, so they're going to save it out of this 86. They spend 60 and they're going to save it 80. No, so that's a different multiplier effect. And if they move through tax cuts or transfer payments, then in the very first stage there is a cut on this spending by MPC. So that's a way we will talk about these two impacts. So multiplier effect of an increase in government purchases of goods and services. Recall that if we assume a simple case with no taxes, no international trade, the multiplier is 1 over 1 minus MPC. So if MPC is 0.5, the multiplier would be 1 over 1.5, which is 2. So it means that if the government is spending 50 billion of new government spending, would create a 100 billion increase in the real GDP. Why? Because it's multiplying. The government is going to spend 50 billion, and then it's going to be income for 50 billion for household. Then household is going to save some portion and then spend it out of it. That is going to create an income for others, and this process continues. Now, in order to understand this, what I said before, that if the government is increasing the government purchases, what is then a multiplier effect? And if they are cutting the taxes or increasing the transfer payments, then how much is going to be multiplier? So the two impacts are a little bit different. So multiplier effects of a change in government transfers and taxes. So will a 50 billion cut or increase in transfers? So if the government cut the taxes in such a manner that they gonna reduce the tax revenue by 50 billion, so have the same effect as a 50 billion increase in government purchases? No. So there is a difference. Now what we are saying, if they reduce the taxes such that the overall income of the household is going to increase by 50 billion, is this the same effect as if the government is spending directly by 50 billion? So the answer is no. The answer is no. So we are assuming again that MPS is 0.5 or MPC is 0.5. So a change in the tax of a transfer is smaller than equivalent change in the government purchase of. So we developed two scenarios. One scenario is that government raises 50 billion raise in government purchases of goods and services. So they're gonna, in the first round there is a 50 billion spending, and then 50, because MPC is 0.5. So then in the second round there is an income for 25, then 12.5, and altogether if we calculate it, it's going to be 100. So it means it's the multiplier is 2, which we just said 1 over 1 minus MPC, which is 2. So the 50 billion creates a total impact of 100 billion. But if the government is through transfer payments, so they say, okay, we're going to do the social insurance program and enhance this in such a way that they're going to spend 50 billion more. So what is going to happen? The people get the income, but they are not going to spend all the income. So they're going to spend half, because we are assuming here that MPC is 0.5. So in the first round, the increase is 25 billion, not 50 billion. And then half and half and half. So in that case, the multiplier is 1. So 50 billion increase is going to cost 50 billion. And how we calculate it? The formula is a little bit different. Here we divide MPC by 1 minus MPC. But in case when they are spending directly by direct purchases, then it is 1 over 1 minus MPC. That's a slight difference, and that's important to know. So taxes and the multiplier, the size of the shift of aggregate demand depends on the type of a fiscal policy. Okay, yeah. So we just mentioned that either they are going to spend directly by this way, directly by this way, or indirectly by increasing the transfer payments or reducing the taxes. So the change in government purchases have a more powerful effect, like multiplier is 2 on the economy than equal size change in taxes or transfer payments. So lump sum taxes, we are talking about here lump sum taxes. It's actually more complicated because taxes are in slabs in different income levels. The rates are different. So unlike most real tax policies, we are use simple lump sum taxes, taxes that do not depend on taxpayers' income. If it is not a lump sum tax, the tax revenue will depend on the level of a real GDP and reduce the size of the multiplier. So definitely when the GDPs are increasing, so the tax revenue is also going to increase because of increase. Now, types of fiscal policies other than contractionary and expansionary. So there is a two in how to implement fiscal policies. That's the way that we are dividing. So there are some automatic stabilizers. The government spending and taxation rules the economy. Those who are running under the concept of a rule for policy for fiscal policy cause fiscal policies to automatically expansionary when the economy contracts and automatically contractionary when the economy expands, like employment insurance and these type of things. That is going to be called as a automatic stabilizer. So it's a triggered the economy if the economy is going to be in recession, and it triggers when the economy is in boom or something like this. So that's a way that it works automatically. Most of the Scandinavian countries, their fiscal policies are very automatic stabilizers. So there is very little discretion available to the government to change these policies. But on the other hand, in most of the countries, including Canada or in US or in other parts, the large. In contrast, a discretionary fiscal policy arises from a deliberate action by the policymakers rather than rules. For example, during a recession, the government may pass legislation that cuts taxes and increase government spending in order to stimulate the economy, in which the discretion is with the government that how much they're going to change it with the change in economic situation. So in countries where the fiscal policy is rules based, the governments are not so popular. No one knows very much about their prime ministers, about their presidents, and about this, because they know that they are running just a system in which everything is based on rules. But the countries where the discretion is with the hands of the government, so they are more well known to the public because they are announcing that okay, I am doing this, I am doing this, or I'm cutting the taxes, I'm doing this. So that's the difference. And where the economies are run through rules, their policymakers are not so much getting importance. And we can also say in this way that everyone loves discretion, right? So it's I have to decide. This way, the countries are facing sometimes problem because people are creating policies with some their own interest, with their some own, like in election years, the sitting government is going to spend more, and in so that's the way that we can say that it's a difference. Holding everything, so let's do a once again a small quiz. Holding everything else constant, the multiplier effect for taxes or transfers, so is the same as the multiplier effect for change in autonomous aggregate spending? No, it's not the same. We just discussed that it's a difference. One formula for calculating is 1 over 1 minus MPC. The other formula is calculating is MPC over 1 minus MPC. So that's not possible that we get the same result. So is smaller than multiplier effect for change in autonomous aggregate? And we observe that yes, when the multiplier is on taxes and transfers, that is smaller than if it is a discretionary. And so the correct one is B. Is larger than? No, that's not possible. Maybe smaller than, larger than, or equal to the multiplier effect for a change in autonomous aggregate spending. So that is also not true. So it's only like the option is B. Austerity and multiplier, that is another topic that is very important, because we said here that if we increase the spending or we cut the taxes and we increase the transfer payments, that has a multiplier effect. But at the same time, if we increase the taxes, means reduce the income of a household, or if the government cut their expenditure, so that also have a multiplier effect. And when the government reduce their expenditures, we call it as an austerity measures or austerity, so they want to spend less. So austerity, and the new evidence from Europe suggests that the multiplier effect is real, and several nations experimented with austerity. Austerity means cutting sharp cuts in the spending plus tax increase because of debt concerns, and but May did not. So that's a, we see that there is a percentage change in GDP, and there is a cyclical adjusted budget. So we see that these countries are clustered over here as a percentage change in. So the budget balance. So how do surplus and deficits fit into the analysis of fiscal policy? So are deficits ever a good thing and a surplus a bad thing? And what is the difference between deficit and debt? So that's gonna be, we talk in this portion of this chapter. Like if we have a more tax revenue and less government spending, we call it as a surplus budget. If the government is spending more than the tax revenue they are collecting, then we call it as a deficit budget. Consistent deficit budget create debt for the government, because when there is a deficit, how do you cover it? You borrow money to cover it. So when you borrow all the time, so it's going to be consistent increase in debt. If we are following a surplus budget, then the government can build up the assets as well. So the budget balance by year is that the saving of a government, we can say, is a saving of a government. How we calculate the saving of a government? Taxes, which is T, minus G, which is government spending, minus transfer payments, or TR. We call it as a TR, transfer payments. So if the T is bigger, we get a positive number. If the T is smaller, then we get a negative number. So a budget surplus is a positive budget balance, and a budget deficit is a negative budget balance. So other things equal, discretionary expansionary fiscal policy reduces the budget balance for that year. And on the other things equal, discretionary contractionary policy increase the budget. So if we are reducing the spending or increasing the taxes, so that definitely the budget balance is going to be increased. And if we are spending more, then the budget balance is going to be reduces. The economist also apply this actual and budget deficit of a Canadian economy over this period, and these purple lines are periods of recession, and we see to separate the effect of a business cycle from effect of a discretionary fiscal policy, the government estimate the cyclical budget balance, an estimate of a budget balance. So what we call it as a cyclical budget balance, an estimate of the budgeted balance if the economy were at its potential output. So year of a large deficit also tends to be year when the economy has a large recessionary gap. So these are the recessionary periods in which we see that the government spending more than the adjusted cyclical budget deficit. Like when the budget is at its maximum potential, then, and as compared to the actual one, and we see that during recessions is always increasing, like this portion you see, this portion and this portion, because of a recessionary. So holding everything else constant, the government's deficit when it is going to happen tends to increase during a recession. That's true. Tends to increase during an expansion. That's not true. Will increase if the government pursue expansionary fiscal policy. That's true. So by this way we can say that A and C both are correct. So option D is the right option. Long run implication of a fiscal policy deficit, we see with reference to Europe, the Greece was in trouble. Why it was in trouble? Because of a consistent deficit. They have a huge debt, and the debt creates a problem for the economy. So persistent budget deficits have a long run consequences because they lead to an increase in public debt. And in 2008, the government of Greece could borrow at interest rate barely higher than those of Germany. So here we see that they are paying the same level of interest rate on their debts, But in 2009, it starts increasing and it's going to reach to this point. Like the interest, the Greece has to pay on their debt, and the interest the Germany has to pay on their debt. Why? Because the countries, those who are lending, or the institutions those are lending to the Greece government, they feel that there is a risk of a default, and because of a risk of a default, they're going to charge them high interest rate. So if they want to float their bonds in the bond market, like for borrowing purposes, so what they have to do, they have to offer a high interest rate to sell their bonds. Otherwise, no one is going to buy it. So why this way we see that when the country is going to getting in under a huge debt, then they have to pay a very huge interest rate because of the risk. That's the same case with the individual as well. So if you go to borrow from a bank, so if you have a good credit score, and credit score is dependent on how much debt you have and how much regularly you are paying your debt, your liabilities, your obligations, so then the interest rate they're going to charge you is less as compared to someone who's having some issues with their finances. So then they're going to get it at a very high. So probably the bank is going to refuse, then they have to go to the private lenders, and definitely private lenders are charging high interest rate as compared to the banks. So deficit versus debt. So deficit is the difference between amount of a money a government spend and the amount it receives in taxes over a given period. Like in a year, how much taxes they are collecting and how much money they are spending. The difference of this is either a deficit or a surplus. But when we are saying debt, so debt is a accumulated loan. A debt is a sum of a money a government owns at a particular time, and deficit and debts are linked, but they are not the same thing. So we have to be very careful. Deficit is different and debt is different. They are linked in a way that if we have a deficit, then it's going to translate into debt, because we have to cover that deficit by borrowing. But debt is not same like a deficit. So debt is accumulated. If you have every year, if your country has a every year deficit, so it's going to accumulate the debt. So at some point of time, in a particular year, the deficit is can be a small, but if you have to look at the debt, it can be big, because it's an accumulated over the period, over the last couple of years, or maybe last 10, 20 years. So that's because government debt grows when a government run deficits, but they are not the same thing, so they can tell different stories. So this graph is interesting, although it's a little bit old, but it's interesting in this way that we can see that the Greece is borrowing how much money, or their debt is how much? 202.8% of their GDP. So double than their GDP. That's so much loan, and that's why they have to pay the highest interest rate as compared to Germany. And you see all these countries like Japan, Portugal, Italy, France, Spain, United Kingdom, so they all have a debt. Why? Because they run deficit budget, so then they have to borrow, and by this way they accumulate. And even we in Canada, we have a 26.9% debt to GDP. And you can see Greece is so much high. The only country, and as I mentioned earlier as well, that Scandinavian countries, and Scandinavian countries' fiscal policy is mostly rules based. When there is a rule base, so then there is no we cannot go beyond certain limit of a deficit, and for that reason they don't have a debt, so much debt. And we see here Norway has a liabilities. Its graph is on the other side, and the other rest of the countries have a graph on this side. So this side means that they have a debt, but on this side they are reflecting that they have a assets. So instead of the government which are in debt, the government of Norway has assets. So they are no debt. So they are having assets. So problem posed by the rising government debt. What are the problems that the government can face if the debt is increasing? Public debt may crowd out investment spending, which reduces long-run economic growth. And in extreme cases, rising debt may lead to government default, resulting in economic and financial turmoil. Cannot a government that has trouble borrowing just print money to pay its bills? Yes, it can, but this leads to another problem, and that's what we call it as inflation. So, if they use this way that they can print money and they can pay back, or they can spend, and creating no deficit, so that is going to cause an inflation. Now, this is a, GDP, debt to GDP ratio, over this period of around 70 years, and we see that the numbers are, these countries having, initially in this period you see it's a downward trend for all the countries, most of the countries, and then there is an upward trend in this period. uh, so after 1990, we see that, or a 95, we see that there's a increasing trend in this. So and if we look at the Canadian position, so the Canadian position is here like this, maroon color line. This reflects that, a widely used measure of fiscal health, with the debt to GDP ratio. Now, other than debt, the government also have a liabilities. We call it as an implicit liability. Now, what are these implicit liability? Experts on long-term debt issue tend to view Canada's fiscal position, not to mention that of other countries such as the United States, Japan, and Italy, with a little alarm. The reason is implicit liabilities. In Canada, we have a implicit liabilities. And what is the implicit liabilities? Spending promises made by government that they are effectively a debt despite the fact they are not included in the usual debt statistics, like a pensions, like old age benefits. So if that cannot be denied. So the preliminary budget office, parliamentary budget office, the aging population plus rising healthcare cost will soon pose a real problem for the federal budget, and we see that these benefits, elderly benefits, Canada social transfers, Canada health transfers, these are all increasing every year. And by this way, we see that in 2035 is going to increase 3%, like elderly benefit, and social transfer is increased by 0.5, and and then Canada health transfer is increased by 1.6%. So that's the, the way we can see. The good news about the implicit liabilities is that government can change it, because it's not a debt in which you cannot change it. But in implicit liabilities, we can change the policies, so these implicit liabilities going to be reduced. Unlike debt, which must be either repaid or defaulted on, implicit liabilities can be brought down by the government policies that reduce future spending. So this is all what we want to discuss about the fiscal policy, with reference to Canadian economy, as well as in general, how the economies use the fiscal policy in order to deal with the economic problems of a recessionary gap or an inflationary gap. So I hope you enjoyed it. Please subscribe and share. Thank you very much.